Fundamentals of Income Tax, Part 10, that is Chapter 9. My name is Brian Clark, and I'll be your instructor this evening. And we are going to be starting Chapter 9. Chapter 9 is sufficiently large enough that we are going to be carrying forward and doing a little bit of Chapter 9 in our next session as well. So we will most likely not be getting to the chapter review problems for Chapter 9 in this session. As well, in this session, we will begin by reviewing the answers for self-test number 3. So if those of you at home listening to this online have not done self-test number 3, go and do that, and then just pause and then come back. We'll wait for you, and then we can go through together. All right, so welcome back, everyone. Here we are just back from the weekend. It was a very wet and dark and all-around unpleasant time out here. I hope wherever you are, it was a little nicer. Just a reminder to everyone, if WebEx happens to drop you out of the chat, or it restarts for some reason, or you lose connection or anything like that, when you're trying to get into the class, just remember to work through the checklist here. If you are having trouble getting sound, enable pop-ups, turn your volume up, and so on. And lastly, that last little one, click yes when WebEx prompts you that you want to join the conference. WebEx sometimes will spawn that window under another window. So if you're really having trouble, just double check the taskbar at the bottom to make sure there isn't a hidden WebEx window somewhere with which you need to say yes to. All right, just a reminder to everyone that questions are fine. I'm one of the developers of this material, so often questions are very helpful for me to understand if a point maybe isn't sufficiently clear in the text. Maybe there's something we haven't put enough focus on yet. Of course, we have to balance different things, of course. But there's no such thing as a bad question. There is such a thing as a question which we are going to answer in a future session, of course. But there's no such thing as bad question. And even those of you who have downloaded this and are listening at a later time, I don't mind the occasional email if you're asking about something if it's unclear. But remember, I'm not your instructor, so I cannot answer those kinds of questions. All right. Respecting class times, we will be finishing at 9 o'clock tonight. As I was saying to my students here, I'm not feeling too great today, and I want to conserve my strength for the rest of the week. So we won't be running long today, barring something really remarkable, especially since we're going to be continuing Chapter 9 next time. So anything we don't finish today, we can put off until next time. All right, now that's it. In our last session, we talked about the subcategory of investments that are known collectively as registered plans. And as I said last time, we can think of registered plans as a private investment portfolio which is sheltered from tax in some way. They are not technically what most people would refer to as a tax shelter, but you can kind of think of it mechanically. That's what they do. They protect your income from your investments in that portfolio from tax, paying tax immediately in some way. The most common one we looked at is RRSPs. These are registered retirement savings plans, and there are a lot of rules around them, and they are by far the most common registered plan that people use. And we talked about things like the limit for contributions that you can make, which then becomes which is related to the limit of how much you can deduct from the RRSPs. And we talked about the mechanical process of making contributions and claiming deductions. We also talked about 2 types of special withdrawals from your RRSP, known as the Home Buyers Plan and Lifelong Learning Plan withdrawals. And these essentially are interest-free loans from your own personal retirement savings portfolio to yourself to help finance the purchase of a home or post-secondary education. And then we talked about some of the restrictions from that. In particular, we stressed that you needed to make those withdrawals in a certain way. meeting certain conditions. If you are not careful, these withdrawals would be treated as our RSP income and would be immediately taxable. We will talk more about RSP income in a future session. Don't worry about that for now. Another thing, we also talked about other registered plans such as the RDSP, the Registered Disability Savings Plan, the FHSA, First Time Home Buyers Savings Account, and the TFSA, which is a tax-free savings account. That is an interesting one because it is unlike, say, an RRSP, where the money in the RRSP has not paid tax yet. In the TFSA, it is post-tax money. So all your money that you put in a TFSA, it has already had tax paid on it, so it is not considered to be income, and any income generated within the TFSA is also not considered to be income. So some interesting variety and flavors of registered plans last time. Now, guys, did you have any questions left over from last time? Was there anything unclear from last time that you wanted me to go into more detail about? And of course, remember that there is always more detail in the textbook than we have time to go through in class. Even in a 3-hour session, there is more detail there. And generally speaking, the answers to most things can be found in the textbook if you're having trouble with anything. All right, let's move on to what we're going to, let's review what we're going to talk about today. Today, we are going to be talking about spouses and dependents. Now, these are an important pair of concepts that come up a lot in tax. We're going to talk about what are the various kinds of dependents, what makes someone a dependent, and we're going to talk about the difference between a spouse and a common law partner. And by and large, anytime that we refer to spouse as opposed to common law partner, most of the time we mean both. The differences between the two categories are small and somewhat technical, but it is useful to know the difference. We're also going to talk about a very important personal credit called the spouse or common law partner amount, which you can claim for your spouse or common law partner, and a credit of equivalent value called the amount for an eligible dependent, which is intended for single people, most usually single parents, who are themselves looking after a dependent. And we will take a moment to touch on the British Columbia personal amounts. These are the equivalents of the personal amounts for British Columbia, but that is not particularly complicated and is only going to take a couple minutes. In some provinces, that may take more time. All right. So by the end of tonight, you'll be able to identify when someone is a dependent for tax purposes, and you'll be able to discuss the meaning of certain terms such as child, parent, spouse, and common law partner. The important thing to absorb is that the meanings of these terms are very specific in tax, and particularly in the case of child and parent, the meanings may not be what you think of in everyday usage. The terms are actually a little broader than you might think. You'll understand how to calculate the spouse or common law partner amount that a taxpayer can claim if their spouse or common law partner has low income, and you'll be able to explain the rules we use when we claim an amount for an eligible dependent and how to calculate that amount. Those rules are reasonably complex, but we use a checklist with them that is in the facts and figures Inkdog, so we will have a look at that checklist, time allowing, when we get there. And we are going to be able to talk about the entries that are required in Schedule 5 if we claim an amount for an eligible dependent. Schedule 5 is the schedule we use to deal with calculating certain personal amounts on the tax return. It is often confused with the Schedule 2, which is used for transferring amounts between couples, so from one spouse or common law partner to the other. Schedule 2, however, is not restricted to just personal amounts and generally doesn't have as much data entry on it. But it can be hard to remember which schedule it is which, so I'm really going to be trying to stress that this is a Schedule 5 thing, and this is a Schedule 5 thing, as contrasted to a Schedule 2 thing. All right, it'll make more sense, or at least be more memorable when we get to the form. All right, but before we do anything else, we are going to review self-test number 3, which by now you all should have had a chance to finish up while I've been talking, if nothing else. And if not, you should be able to make an educated guess about most of these. So not to worry, as always, these are not for marks. It is just to help you gauge where you are with the material and to help me understand if there's any material where you guys need some more detail, a little more time with it, if there's something that's unclear. So it's really a chance for me to get some feedback and say, oh, okay, everyone seems to understand this. I don't need to talk about this so much. Or, oh dear, no one understands this. All right, so let's jump into it. All right, so first question is about dividends. All right, I'm going to move the chat window down here and pull up the polling window and set the timer for 1 minute. All right. Okay, so Stanley received $400 in actual dividends from a taxable Canadian corporation that issues eligible dividends. He also received $15 in interest from the CRA and $100 interest from a savings account. He paid $70 interest on a loan to purchase the Canadian corporation shares and $130 for a subscription to an investment newsletter. So, what is the dollar amount of the interest income to be reported on line 12100 of Stanley's tax return? Is it A, $15, B, $45, C, $100, D, $115, E, $185, F, $400, or G, $520? All right, so nice wide range of answers there. Let's see what you guys think. And I'll put the chat window over here. I'm not sure if I need to have the polling window up too much. I don't want to block the question, but I also want you guys to be able to see the polling window. My understanding is that you can move your own polling window around as necessary. That's good. Good. I had a student the other day couldn't find the polling window, and I was like, "Oh no, have I done something?" There we are. Okay, so that was a minute. WebEx is just giving a few extra seconds in case anyone has the window open and hasn't just clicked submit yet. All right. Okay, so the most popular answer was D. So let's see if you are correct. So the things that we need to report: the $15 in interest from the CRA and the $100 in interest from the savings account. So the correct answer is D. So the $400 in actual dividends are not interest income. They are not reported on that line. The investment expense of $70 is also not deducted from the amount on line 12100. It is deducted in the next step of the tax return. So the income only is what goes on 12100, and that's $115. All right. Question number 2. And let's make sure I've got the correct question here. Bit of a simpler question, not quite so many options this time. Gary completed his tax return for the year. Then he discovered a T5007 slip in respect of social assistance he received but forgot to consider when preparing his return. He will now recalculate his return. Which of the following amounts will not change after this recalculation? So A, total income on line 15000, B, net income on line 23600, or C, taxable income on line 26000. All right, let's see what you think. Okay, about 10 seconds now. It's just tabulating the results. Right? That's right. The most popular answer here is C, which is correct. So the taxable income will not change. So when we look at these, the important thing to remember is what we're talking about here is income, which has to be reported on the return, whereas the income added, it is added in the total income step. So the total income number will change. Then, if we remember correctly, social assistance or workers' compensation payments, these kinds of social benefits are non-taxable, so they are deducted. So, however, they are deducted in the net income step. So they are deducted in step 3 of the tax return. So the net income number is also going to change. Right? So what happens is they are added to total income, which goes up, and then they are subtracted from net income, which goes down. So the taxable income then is the only thing which will not change. All right. Because the conceptually, these types of social benefits are included in net income because they have an effect on eligibility for certain social benefits like the GST rebate, tax credits, and so on, which makes sense if you think about it. Consider the case of someone where they have $50,000 in workers' compensation benefits. These are not taxable, but this person also is not really a low-income person who should benefit from, low-income GST, so rebates. So their net income will stay relatively high to reflect the fact that this person does have enough money to live on. if that helps. All right. All right, now let's have a look at question 3. There we go. Make sure I've got the right one here, and I've set it for 1 minute. 1 minute. There we go. All right, so Adam has a taxable income of $70,000. Approximately, how much would Adam save in income tax federally by making a $4,000 RSP contribution and deducting it on his tax return? All right, is it A, $600, B, $820, C, $1,040, or D, $1,160? All right, let's see what you think. Yep, you didn't see that. Question 5, yeah. Okay, so, all right. There is a most popular answer, but let's see if you're right. So, indeed, most of you are correct. The correct answer is 820. So, for anyone who is unclear, remember Adam has a taxable income of 70,000, so he is well within the second federal tax bracket, which is taxed at 20.5%. By putting that $4,000 in the RSP and deducting it, he's telling the government, please do not tax me on this $4,000 at 20.5% right now. So his tax savings for the year from the RSP alone, nothing else, the RSP contribution gives him a tax savings of $4,000 and 20.5%, or $820. All right. Whoop. So here's question 4. Let's pull this up, make sure we've got this. WebEx is trying to give me the wrong question, but I have it right there. So the question is, in what year does the taxpayer need to claim a principal residence designation? Is it the tax year the home was purchased? Is it B, the home was owned, every tax year the home was owned? C, the tax year the home was sold? Or D, none? All right, let's see what you think. More of a spread of answers this time. Just totaling this up. All right, so the most popular answer was C, which is correct. So, let's remember what's going on here. The principal residence designation is important because it means the principal residence being sold is exempt from capital gains treatment. In other words, the principal residence is not considered to be income when you sell it at a profit. If we use logic, we should be able to eliminate some of these possibilities right away. So, for example, we know that a designation needs to be made. Otherwise, the government does not know that this is your principal residence and does not know that it's supposed to be exempt from this treatment. It is necessary to report the sale on the tax returns, but it is also necessary to make the designation. Now, if we think about that, then we can also tell that A isn't possible because the year the home was purchased is not the year that it's going to be sold normally. And so there would be no need to make this designation then. And you might have more than one property, and this might not be the property you want to designate as a principal residence when you actually do sell the property. You could have more than one house. That's the thing to bear in mind. Any sale or gain or loss of the property is entirely hypothetical until the sale actually takes place. So there's no need to make this designation until then, because you want to maintain that flexibility until the actual time comes. And then the designation is simply for the year it was sold. And in that year, then you could say, yes, this was my principal residence every year or only some of the years. But until that time comes, you don't need to designate anything at all. And it would be, the CRA doesn't track that information. They do not want to get bogged down with tracking all that information. And again, this makes sense because you want to maintain this flexibility until the sale actually happens. I had a student last year who was very, very concerned that they had bought a house and wanted to make sure that the CRA knew how much the house cost. And I had a hard time explaining to them that you really don't need to, because the CRA does not track or record that information. That's not what they're doing. All that's necessary is for you to record the information, have your documentation, and then when the house is eventually sold, then you need to give it to the CRA. But I had a hard, my student was extremely hesitant to accept that, but it's true. You don't need to do anything until the year something is sold. You need to keep your records. You need to be able to substantiate your numbers, but until actually something happens, nothing needs to be reported. All right, and lastly, our big one. Let's see how you do with this guy. All right, so let's make sure I've got the right question here. Let me make sure I've got the timer set for. What are you doing? That's weird. Okay. Oh, I see. I see what happened. All right, not to worry. Okay. WebEx. All right, so. Okay, this is going to have more letters than you actually need, which is all right, as long as you got enough letters. Okay, all right, so on February 15th, Jody had 17,000 in her RRSP. On that same day, she made a contribution of 6,500, increasing the total to 23,500. March 1st, the RRSP was credited with $1,500 in earnings, increasing the balance to 25,000. On March 15th, Jody went to the bank to withdraw RRSP funds to help her purchase her first home. So, bearing in mind, Jody wants to deduct her February contribution. What is the maximum eligible amount she can withdraw from her RRSP under the home buyer's plan? Should A, 6,500, B, 17,000, C, 18,500, D, 23,500, or E, 25,000? All right, so let's open the poll and let's see what you think. All right. And obviously don't select F or G because those aren't valid answers this time. Or I mean, I'm not your dad, but I'm telling you, F or G will not be correct for this one. Yeah, I see that now, Valerie. WebEx does this weird thing with poll questions. Is the short answer there. As long as you have enough letters to answer the question, and you've got the letters you need to answer the question, it doesn't make too much difference. But yes, when I set up the poll questions beforehand, WebEx does this odd thing where it will put them out of order. Unless you're reading really carefully, you might not notice that you've selected 1 versus 3, particularly if they have the same number of letters. So answers, I guess, rather than letters. But yeah, we simplified our polls this year so that all of the poll answers are just letters rather than the entire answer typed out. And that does make it hard to tell at a glance when you have pulled up the wrong poll question. All right, I can see here that, yes, so there are a couple of popular answers. Let's see which of you guys is correct. All right, so I'm going to show you how we arrived at this on the next slide, so don't worry. But the correct answer is C. So how did we arrive at this? So first thing to remember here, the February contribution occurred within 89 days of the home buyer's plan withdrawal, right? It has not, the financial term for this, vesting. It has not vested in the RRSP yet, so it cannot be withdrawn under the home buyer's plan. And indeed, if she does withdraw it, she may not receive a contribution receipt for it if she withdraws it prematurely, which would be disastrous. So the important thing we always want to stress to people who are considering using the home buyer's plan provisions is that you need to put your money in the plan if you're going to, but leave it there a minimum of 90 days before pulling it out to buy the house. Otherwise, you risk having a problem like this. So the way we phrase the rule is, in order to claim the full February contribution, the balance in the RRSP account after the withdrawal must be equal to or greater than the February contribution. In other words, there needs to be enough money to cover the February contribution, which effectively still sits in the plan. So there was $25,000 in the account right before the withdrawal. So the $6,500 cannot be withdrawn. Other things can be. So this means that she can make a maximum withdrawal of $18,500, and this leaves $6,500 in the account after the withdrawal. If she had been able to wait a full 90 days, she would be able to withdraw the entire amount. All right. Okay, I hope that's clear, everybody. The main thing I always stress is that when you're using the home buyer's plan, you've got to be very mindful of this need to let things vest, and you've got to be very mindful that you are filing the correct paperwork with the bank and saying, I want to take this out as a home buyer's plan withdrawal, because if you just do a regular withdrawal, it will be subject to income tax in that year. And there isn't really a path to retroactively designating something as a home buyer's plan withdrawal. You would have to, at tax time anyway. I'm not sure if you could go to the bank and say, oh, wait, this was supposed to be a home buyer's plan withdrawal. Can you change this after the fact? And even if you do, the bank will have withheld income tax on it. So just better to just make sure, 100% sure it's done correctly the first time. All right. So good work, everybody. Hopefully we're all in thinking mode now. So now let's have a little bit more discussion, a few more activities to solidify things. So let's chat about RSPs a little bit more. The taxpayer's only income is from employment, the amount of $16,000. During the year, they also open an RSP account and they contribute $1,000, and they've done nothing else to add to their tax return. Okay, so how will the $1,000 RSP contribution help their current tax return? And do you guys have any tax tips or suggestion? Mohammed has got a question. What is the last day to do the RSP contribution for the year? Okay, does anyone remember the rule? Can anyone tell Mohammed? Right, it is the first 60 days. So the last day you can do an RSP contribution is the 60th day of the year, which will be March 1st, or in a leap year, February 29th. And if that 60th day falls on a weekend, then the deadline date will be the Monday immediately following that weekend. Exactly, Valerie, exactly. Thanks, Gajender. Yeah, so this means it's going to move around from year to year depending when the weekend falls and whether it's a leap year or not. But it will range between February 29th and March 3rd, depending on the year. So for any individual year, you want to, just double check. You don't want to leave it to the last minute anyway, but yeah, just double check to be safe. Now, the receipts you get back from the bank or the financial institution will clearly mark which contribution period it's in. So if it says March 1st or something like that on it, you want to check the rest of the receipt, because in addition to the date, they will indicate the contribution period as well. All right, but now let's look at this case here. So this taxpayer, assuming they met the deadline, contributed $1,000 into their RSP, and their income for the year is $16,000. So is the RSP contribution going to help their current year tax return? All right. So you're all correct. There's almost certainly going to be no benefit here. It's because their income for the year is already below their credits. So this is employment income, right? So their basic personal amount plus the Canada employment amount is going to be higher than 16,000. And if there's CPP and EI contributions as well, definitely their income is going to be well below their credits. So those are non-refundable credits, so their tax is already going to be at zero. It's also likely going to be at zero for provincial tax. There might be a province or two where there's some very small provincial benefit, but that is, much less than 15% return on it. One thing to consider, by the way, apart from tax, are situations where having a lower income will lead to other benefits. So, as we'll learn later on today, sometimes it can be beneficial to a spouse's tax return to lower your income below the basic personal amount, even though it's not going to affect your taxes directly. In this case, the taxpayer is intended to be single. But there are other factors to look at as well. So would lowering their income lead to them getting back less of the Canada Workers Benefit? In this case, it would reduce their Canada Workers Benefit. Would it lead to them getting less back in their GST rebate? In this case, it would lead to them getting less back in their GST rebate. The only unambiguous benefit they would get is that they would get back a little bit more of the British Columbia sales tax credit, but that is only $75. So that's a very small return on $1,000 of RSP. So while there may, I don't want to say in 100% of cases, 100% of the time, if someone is not single, especially, that there would be zero benefit to this, but there certainly will not be any increased tax refund resulting from this. So bearing that in mind, what tax tips or suggestions can we make for this person? Carrying it forward, Grant? Good. Because we have the flexibility to claim this in any future year. Absolutely. Another thing we would want to look at is, does this person have the deduction room to make a contribution, an RSP contribution this year at all, right? If they have contribution room, it's not a problem. They can claim it in a future year. If their contribution room is at zero or less than $1,000 for some reason, they'll still be okay because of the $2,000 cushion, but you would want to look at it closely and make sure they didn't have excess contributions left over from the previous year or something like that. All right. So in most cases then, we would presumably want to carry this forward for a future year and then discuss with the client the benefits of doing that. Okay. Now, it is true, though, if someone has a spouse, that your income might have an effect on their return. So let's get into our main topic for tonight, talking about spouses and dependents. Now, I've added some language here to make sure that that everyone is very clear about this specific term. So dependent with an A is a person. This is a noun. The adjective with an E, dependent, is an adjective. So a person can be dependent on someone. They depend on the taxpayer for support, but the person themselves is referred to as a dependent. And so that is someone who depends on the taxpayer for support. Now, this is important for various tax credits and benefits involving dependents, and many credits require the dependent to be a relative, either by blood or marriage or common law partnership or adoption. In most cases, the dependent needs to be resident in Canada. There are a handful of exceptions, and most credits are also limited by the dependent's net income, not taxable income, but net income. All right, now we're going to define support on the next slide, not to worry. But before we move on, a couple of notes we want to add. So first, there's no single definition of dependent in the Income Tax Act. So someone might be a dependent for one credit, but not qualify for another. In general terms, though, we can think of it as a relative who relies on the taxpayer for support. Now, again, a relative who qualifies in one context may not qualify in another, and there's no particular logic behind the variations, but particularly for things like uncles and nieces and things like that, they might not qualify for all credits. In general, you should always refer to the text or the guidelines to determine whether someone is going to qualify as dependent in any kind of gray area where there's any kind of uncertainty, rather than trying to memorize all the various qualifications, because there's a lot. But bear in mind, the exam is open book, so you can look up this information and look up the definitions and the requirements as necessary when the time comes. All right, now Bilava's question. Is there an age limit for the dependent with an A, right? Dependent. And can a person with disability also be a dependent even if they are of age? That is, as you will see, that is exactly the thing to focus on. Age is a factor for some credits. Generally speaking, someone can be a dependent for certain credits only if they are 18 or younger, or if they are disabled or infirm, and this is what makes them dependent of somebody. No, that's all right. I'm just focusing on the spelling to help everyone remember it, and that there is a difference. It's they're two different words, and I'm just kind of stressing that to help it stick in everybody's mind. All right, so supporting a dependent is not defined in the Income Tax Act, which means it uses something of the just the regular meaning. It doesn't have a special definition, and the regular meaning is that it means you're providing someone with basic necessities of life: food, lodging, clothing, medical care. It doesn't have to be total support, but you are providing some support to the person. They are unable to fully support themselves. I think I can illustrate this very easily with the example of rent. Now, say I am living with my son, for example, and I am paying 100% of the rent. Obviously, he depends on me to pay the rent. But let's say I'm living with, let's say my son is 18 or over, but infirm, disabled, and can't work. Again, I'm paying 100% of the rent. That's clear. But perhaps it's my elderly father, and he can pay some of the rent, but not a full 50%. So he's only paying 20 or 30% of the rent, in which case I'm paying some of his share of the rent. I'm supporting him, vice versa, right? So it's not necessary that I pay 100% of it, but you are shouldering some of the burden for the other person. The CRA refers to this as being a question of fact. You either are doing this or you are not, and occasionally you may be required to provide documentation demonstrating that you are paying the bills and you are buying this person's food, and so on and so forth. The contrasting situation would be maybe a roommate situation. You're in college living with somebody, and they are putting in money to the household, but they're only kind of putting in their half the rent and their half the meals. So if all they're doing is putting in money to support themselves, they are not going to be considered to be supporting anybody else. That's the general uh, way to think of it. Okay, Muhammad asks, if I am living with my girlfriend, um, one word, girlfriend, as a common law partner, and we have a kid, according to the Canadian law, can we treat that child as a dependent? We will get there. Don't you worry. Yes, don't you worry. Um, and remember, the importance of being a dependent is that you qualify for various tax credits and benefits, right? We're not just doing this for fun. It's so that you can say, yes, I am supporting this person, therefore I should pay less tax. All right. Also note, this only needs to be provided at some time during the year. So if, for example, um, someone who is dependent on me is injured in an accident and can't work for 3 months of the year, and I have to pay some of the rent, their share of the rent for 3 months, then that is sufficient to trigger this. Although, again, I might need to document that for the CRA. All right, now, the most common type of dependent is a child that you are being a parent to. And what isn't obvious to people who haven't studied tax is that the definitions of this for tax purposes are a little wider than the average person might think. So, for tax purposes, then, the definition of child, in addition to a natural biological child or an adopted child, also includes any dependent who is or was under the taxpayer's custody and control in law or in fact before turning 19, and wholly dependent upon the taxpayer for support. I'm sure you all remember the famous case from the headlines where Bruce Wayne, the billionaire philanthropist from Gotham City, was at the circus, and a young man named Dick Grayson lost his parents in a tragic circus crime. And so the young man, Dick Grayson, at the age of about 13, 14, came to live with Bruce Wayne, and Bruce Wayne looked after Dick Grayson because that's what wealthy philanthropists do. But no formal adoption was made. In that case, right, the Bruce Wayne would be able to claim that Dick Grayson was his child, even though no adoption had taken place, even though there was no biological link between the two. Right? In more mundane examples, as we will see, there's plenty of cases where someone who is under 19 has to go live with someone who is looking after them, but they're not the biological child, and there's been no adoption. So this comes up more often than we might think. So for tax purposes, then, the definition of parent has also been extended to cover the same relationship as above. So if this person is a child that you are looking after as a parent, then you are the parent to that child for tax purposes. So we're going to look at some scenarios, and we're going to determine whether the dependent qualifies as a child for tax purposes. All right, so first, Harpreet. Harpreet is single, and after a year of going through the adoption process, adopted her son, Krishna, in the summer of 2024. Is Krishna considered the child of Harpreet? Excellent. So, yes, right? Adoption is a legal process, a legal recognition of parenthood. So yes, for all purposes, then Krishna is considered the child of Harpreet. After the sudden death of Molly's sister, Molly's 8-year-old niece, Liz, began to live with Molly. Molly does provide all the necessaries of life for Liz. Is Liz considered the child of Molly? So again, here, the answer is yes. So notice, there's been no adoption, right? And Liz is not the direct child of Molly, just merely a relative, but Molly is acting as the parent here. There's a legal concept called in loco parentis, which kind of talks about this as well. Basically, Molly is the responsible adult. Uh, Molly is keeping Liz alive, providing all the necessities of life. So Molly is the parent and Liz is the child. Exactly, Nika. She provides the child's needs, has control and custody of the child. Right. Carol is 17. Her birth parents died last year. Carol moved in with her uncle David. Carol is wholly dependent on David for support. Is Carol considered to be David's child? Good. So the key phrase here is wholly dependent on David for support. It's not impossible to imagine a situation where a particularly independent 17-year-old might be completely supporting themselves financially here, but in this case, it's quite clear Carol is David's child. Now, let's look at this example. Adam is 22 and has developmental issues. Adam's birth parents died last year, and he moved in with his uncle, Bob. Bob takes care of Adam, and Adam is wholly dependent on Bob. Is Adam considered to be Bob's child? So, here we see the difference between child and dependent, because Adam is a dependent, but he's not considered to be Bob's child. He's over 19. Now, what would have happened if Adam's birth parents died earlier, when Adam was, let's say, 5 years ago? So let's say when Adam was 17, his parents died. Would he have moved in with Bob? Would he now be Bob's child 5 years later? Exactly. Right. Right. He 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 would be Bob's child and an adult dependent in that case. And this is important because being a child or not uh, has an effect on what type of credits can be claimed for someone. Um, so this, not often, but sometimes, will be an important distinction to draw. Okay. All right. With all that in mind, I think we're comfortable with that. So, it's complicated a bit. Now we're going to look at spouse versus common law partner. So, spouse is straightforward. Spouse is someone to whom one is legally married. There was a marriage, there was a legal agreement. You went down to City Hall, your name is registered in the book. You are, in the eyes of the law, spouses. The main difference between a spouse and being someone's common law partner is that for spouses, separations of less than 90 days do not constitute a change in marital status. When you are someone's spouse, you are legally married. So A brief separation cannot affect this status, and there is no requirements for living together for a certain length of time or anything like that. That is different from being a common law partner. You become a common law partner with someone when you have lived with them in a conjugal relationship for a minimum of 12 continuous months. Or you live with the taxpayer in a conjugal relationship and are a parent of the taxpayer's child. So in other words, if there's a child, using the expanded definition of parent and child, and you move in with someone, then there is no 12-month waiting period. You are instantly considered common law. Separations of less than 90 days do not constitute an interruption of the 12 continuous months. Separations of more than that do, however, restart the clocking. Okay, so just like we did with child, we're going to have some practice and see, for each couple, can you determine their marital status for 2024? So first, one at a time. Harry and Sophia moved in together on June 4th, 2024. Neither have any children. What will be their marital status on December 31st, 2024? Excellent. They are single, right? They haven't been together long enough. They are considered single at this time. Next, Marcia gave birth on August 18th, 2024. Ralph is the father of the child. Marcia and Ralph moved in together on September 24th, 2024. What is their marital status on December 31st? Excellent. So they are considered common law partners on December 31st. And in fact, they became common law partners on September 24th when they moved in together. Now, this is an important thing to bear in mind. Someone can be in a relationship with someone for any length of time, but so long as they are living at separate addresses, maintaining separate residences, then the clock does not start. I occasionally meet people in their 70s in my lobby and waiting room who have separate addresses on the tax form, but look at each other and giggle a lot and put themselves down as single. I mean, I'm not saying it doesn't happen, but there is a suspicious amount of giggling going on sometimes. Right. Oh, and what about the 12 months? Mohammed, remember, if you are the father of the child, right, or a parent of the child, then there is no 12-month waiting period. And when you move in together, you are considered common law. Remember Bilal? In this case, Ralph is the biological father of the child, so there's no confusion here. We'll look at some more examples, and I think it'll clarify a bit. But in this case, there's no confusion. Ralph is the biological father. Okay. Now, Alan married Amanda on September 15th, 2024. They did not live together before getting married, and after their honeymoon, Alan was suddenly posted overseas for 6 months. And as a result, they were not living together at the end of the year. What is their marital status on December 31st? Exactly. They are legally married. They are spouses. The separation does not change that status. And particularly if it's not due, unless it is due to the actual breakdown of the relationship. Being physically separated, not living together, has no effect on your marital status if you are legally married. So they are married, again, as of September 15th. That's the date on the marriage certificate. Okay, number 4. Clara has a child from a previous relationship. Clara's boyfriend, Felix, moved in on November 12th. Felix, being a cad, does not help with any of the bills and does not assume any parental responsibilities. All right, so what is their marital status as of December 31st? They are single, yes. Well, I mean, Valerie, it really depends if Clara wakes up about the situation, but no, they are single. They are single, and not boyfriend and girlfriend. Remember, that is not a status on the tax return, right? Whether people are in a relationship having a good time is not our business. Remember, there's no moral judgment associated with any of this. Uh, it's simply, are they financially speaking a couple? Which is an independent question of whether Clara can do better than Felix, and I think she can. Right? It's either married, common law, or single. Right? There is uh, when we're talking about two people. Yeah. All right. Now, speaking of rotten fish, Ada and Kevin have had an on-again, off-again relationship for years. In 2021, they had a child together. Kevin did not live with Ada at all in 2023, but moved back on December 3rd, 2024. He doesn't pay any of the bills and doesn't assume any parental responsibilities. All right, what is their status going to be on December 31st? Good, excellent. They are common law because biologically, right, it is Kevin's child. Exactly, exactly. There's no ambiguity here. There is a child. How he acts is irrelevant if it is biologically your child. So Kevin is a parent of that child biologically and legally, and so they are considered common law. All right. We're going to throw a few more at you. So, 6, Benny and Ramon moved in together on December 31st, 2023, and they have no children. What is their status going to be? Yes, for December 31st, 2024, what will their status be? Common law. Yeah, it has been a year. Good job, these crazy kids. They managed to make it last 1 year. They are considered common law. All right. Number 7. Valerie and Susie moved in together on June 11th, 2024. They adopted a child together on July 2nd, 2024. What is their status going to be? Good. Again, the status is common law, and it is common law as of July 2nd when the child arrives. And again, this child is legally the child of both of them, so there's no ambiguity here as well. All right, and number 8, Robert and Kendra rented an apartment together as roommates on April 14th, 2023, and continue to live there. They are not a couple. That is, they're not in a conjugal relationship. Well, what is their status going to be at the end of 2024? That's right. They are both single. Again, roommate is not a status on the tax return. Now, if this were a romance novel, then it might be a different story, and they are roommates, but perhaps they are slowly coming together. We will see. We will see. But certainly, at this point, at the end of 2024, it's still early in the series, and they are both considered to be single for tax purposes. Right. If you do tax long enough, you will see pretty much everything eventually. Is my take on it. So, but apart from all the human drama, it usually comes to for marital status, it comes down to very simple question of fact and considering the situation. All right, good. And let's give you two more, and then two more, and then we'll take a break. A little early, but it's about halfway, so it should be okay. All right, so 9. Vicky and Ray moved in together on May 23rd, 2024. Ray has a child from previous relationship. Vicky provides complete support and takes on parental responsibilities. All right, what would this be? Good. This is common law, and they will be common law as of May 23rd, 2024. And one last one, Holly and Eric moved in together on February 22nd, 2024. Holly gave birth to their daughter Serena on November 30th, 2024. What is this one going to be? Good. Again, common law. Common law as of November 30th. All right. Now, actually, how are you guys feeling? You want to go about another 10 minutes and then take a break? All right. So we'll break around 7:30, I think. So the reason that we are concerned with these statuses of child and parent and common law partner versus spouse is, of course, that these allow us to qualify for various tax breaks and tax credits and things of that nature. So, where did that go? The first one we look at is what's called the spouse or common law partner amount. Actually, Elab, this is a good question. Do they not need to sign any papers, or do we just take their word for being common law? They are signing the tax return. The tax return itself is a legal declaration. We do not ask to see someone's marriage certificate, and they provide us with the date we're going to use. If someone is really shifty about it and we have reason to suspect that there's some sort of fraud going on, we do not have to complete the tax return, and we are required by law to have a tax return be as full, as accurate as possible. But in the normal course of events, we don't ask to see any documentation. The CRA can request to see documentation, and there is a form you can file with the CRA to update them as your marital status. Last year, we had some new software, which one of my associates had a little trouble with and accidentally filed someone as common law when they were actually married and vice versa. So we, had to send a letter to the CRA and say, whoops, even though it doesn't affect the tax return at all, in fact, their couple status did not change in that way. When you're talking married versus common law, it's fairly innocuous from a tax point of view, because as we will see, they are the same financially by and large. But putting someone down as common law when they're actually single or vice versa can have dramatic effects on the tax return. So let's talk a bit then. Actually, because you asked, I think this would be a reasonable thing to look up. So there is a CRA form you can use. I think it's the RC. I want to say RC65. Yeah. So the RC65 is really straightforward. It is a marital status change form, and you mail that to the tax center, which applies to let them know that your marital status has changed. And if we pull it up here, yeah, it's very straightforward. You just indicate your name, address, home address, the change of marital status, and then you sign the bottom. And then you send it to the CRA. Why we had to send a letter in that case where we accidentally put down the wrong status is that the status didn't actually change. So you wouldn't use a change of marital status form to reverse a change which didn't happen, was our thinking. So with the postal strike, it was a little bit delayed going through. So I will let you know if something exciting happens on that front. But yes, this is actually an important thing to be aware of, because your marital status changing will affect your eligibility for certain things outside of tax time. And in particular, it can affect your family income, which is used when we calculate the GST credit that someone gets. So just like if you change your province of residence, you should notify the CRA right away. If your marital status changes, you should also notify the CRA right away, because it may affect the GST benefits that you are getting, either in a good way or a bad way. Many people, because they get married, become common law, it is not the first thing that they think of, that, oh, I should let the CRA know about this. But it is actually an important thing to do, because if you wait until tax time, potentially that could be almost a year before you update the CRA, and then you wind up having to pay almost a year's worth of GST benefits back, for example, because your family income is much higher than the CRA thought it was. So it is important to notify the CRA of this information if there is a change promptly. Otherwise, it can lead to problems with credits. This is also true for the Canada Child Benefit as well, which tends to be much larger than the GST credit. So in that case, it's even more significant. All right. Now, one thing which is purely at tax time and not in the rest of the year. So when your status on December 31st determines whether you have a spouse or common law partner. If the basic way this works is if their income is low, then by definition, you must be supporting them. So thus we have the spouse or common law partner amount. So it's a pretty basic qualification. You have to have a spouse or common law partner, and their income needs to be relatively low. The basic spouse or common law partner amount is going to be the same as your basic personal amount. So depending on your income, not the spouse's, it will be $14,156 if you're in the top tax bracket, $15,705 if you are in the bottom 3 tax brackets, and somewhere between those numbers if you are in the 4th tax bracket. It is also increased by $2,616 if the spouse is disabled or infirm. We will talk more about that in Chapter 10. And we will talk about something called the Canada Caregiver amount. Don't worry too much about that right now, but that's what that is for. So this credit is reduced by the spouse or common law partner's income. So thinking about it, imagine a situation where one partner or spouse has a very high income, is working all the time, has $200,000-300,000 in income, and their spouse is staying home and not working and has zero or low income. Then obviously the higher income partner is going to be paying all the bills, doing all the support, and therefore they get essentially to claim their partner's basic personal amount, whatever that partner is not using. The exact figure is calculated on Schedule 5 and then claimed on line 30300 in Part B of Step 5, right below the basic personal amount for the taxpayer. So it looks like this. It's not too scary. This is Schedule 5 we're looking at here. So first we indicate if your marital status changed to either single or one of the other statuses which are equivalent to single, and so you make that here, and that can be important for the government to know about, and to know about when it happened. Then you put in your basic personal amount, which will vary depending on your income, which bracket it's in, and then if they're disabled or infirm, we put in the Canada Caregiver amount here. So we take that figure and we subtract the spouse or common law partner's net income, and if it's negative, we enter 0, and then we enter the resulting amount on line 30300. As I say, it's the same as your personal amount, basic personal amount, whatever that might be. So let's actually, no, this is a good time to take a break. Guys, before we go on break, though, do you have any questions about all of that? I don't want to pull up the full Schedule 5 right now because there's a lot more to it than just this one section. So we will look at it a little, if not tonight, then a little later in the course. But any questions for now? Are you okay so far? All right, good. So in that case, let's pause things. And okay. Thanks, Dorian. Good. So welcome back, everybody. We've all had a 15-minute break here. And so just to refresh what we were talking about before the break, let's have a poll question. So when determining if someone is eligible for the spousal amount, so if the taxpayer is eligible for the spousal amount, which income from their spouse is relevant in determining the credit? Is it their total income, their net income, or the taxable income? All right, so let's make sure I've got the right question here. And let's see what you think. And we'll also see if anyone is still away on break. But for those of us who are here, take your best stab at it. Okay, so there's a popular answer, but many people still haven't answered yet, and you've got about 20 seconds left. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. And WebEx is just going to take a few seconds to tabulate results for anyone who hasn't responded yet and still has the window open. All right, so most of you got the answer correct here. The correct answer is B, net income. And we can remember this because taxable income is used pretty much only for calculating tax that's owing. Net income is what is used for determining eligibility for various credits and social benefits, and the spouse or common law partner amount is such credit. All right, let's move our, put the polling window down and put the chat window up here. All right, and now let's see. We're going to look at a situation and give you some different questions about it. So first, Arpandeep has been married to Ishwinder since 2021. They have no children. Arpandeep has net income of $40,000 and Ishwinder has net income of $4,500. So what is on Arpandeep's line 30000 and line 30300? So put in your answers and then we'll see how you all do. Good. And just as a best practice, although it's going to be pretty clear in this example, when we're doing this kind of discussion and you have more than one answer to put in, it's helpful to put the line number as well as the dollar amount. So one thing you could do is L3000 and then a dash and then $sign for the dollar amount. In future sessions, we might have questions which aren't quite so straightforward. In this case, I think pretty much everyone's going to be able to tell. All right, I'll give one or two more people the chance to put in an answer, and then we'll show you what it looks like on the form. Okay, I'm seeing a lot of consensus around the answers, so that's good. All right, so keep that in mind, guys. So first, I think this should have been straightforward for most of you. The personal amount is not going to be affected by the spouse's income at all. So your own personal amount is based on your income and no one else's. So, and as we all know, should know by now, if it is in the bottom three brackets, that is $173,205 or less, it is $15,705. If it is $246,752 or more, then you put in $14,156. And if it is between those two numbers, it is in the fourth tax bracket, and you need to go to the federal worksheet. So in this case, the income is well less than that. So the basic personal amount is going to be $15,705. Right, now let's look at the spousal amount. So for the spousal amount, this is calculated on Schedule 5, and we use this to determine the spousal amount. Now, the relevant portion of Schedule 5, remember we indicate if there's been a marital status change during the year. And remember, somebody could be single for part of the year and married for part of the year. So this can have an effect on certain credits sometimes, although we are not talking about that sort of situation yet in this chapter. So there's no change in the year, so nothing is indicated there. And the spouse is not infirm or disabled, so there's no candidate caregiver amount. And so the basic personal amount from line 3000 is $15,705. We deduct the spouse's net income, which is $4,500, and this gives the spouse or common law partner amount, $11,205. Okay, so this is pretty straightforward most of the time. As we'll see at the end of today's session, near the end anyway, when we talk about the British Columbia spouse or common law partner amount, that one's slightly more complicated, but federally it is pretty straightforward. And this is what it looks like back on the main return. So the 15,705 is in at line 30000, and your spouse or common law partner amount comes in at 30300. Now you'll notice that between them there's a credit called the age amount, 30100. So this is if the taxpayer themselves is 65 or older. So if they were born in 1959 or earlier. We're going to talk about that in a future chapter. But notice kind of the sequence. We begin with a taxpayer, and then we expand outwards to a spouse, and then other dependents down here. So it follows a logical order. And Beanish asks a question. If the spouse's only source of income is the Canada Child Benefit, would that be deducted? Who can answer this question? Yes or no, and why? But also why? Why? It's not that it's not taxable, it's not income. The Canada Child Benefit is not declared anywhere on the return, so it's not merely income that isn't taxable, it is not income. It is more akin to a tax refund or a tax rebate is the way to think of it. So the Canada Child Benefit is not considered income. If it is invested in a savings account that generates interest, the interest would be income, but the Canada Child Benefit money itself is not. Yeah, it's a refundable tax credit is the technical term for it. Even though it doesn't appear on the return, it is a refundable tax credit. If you want to think of it this way, it is your tax dollars coming back to you in a roundabout way. All right, so here we total up the personal credits for this person. So basic personal amount plus the spousal amount is a total credit of $26,910. As you can see, if you have a spouse who isn't working, you're getting a pretty substantial, or not working very much, you are getting a substantial tax credit to help compensate for the loss of potential income, essentially. All right, and yes. So let's keep this rolling. So let's assume that that we're seeing this form is for a 20-year-old taxpayer. And this 20-year-old taxpayer, let's assume, has taxable income of $25,000, all of which is from employment. If they had $1,700 deducted in taxes, do you think they would have a refund? So given what we know here, So good. Why do you think no, Mohammed? Everyone else seems to be saying yes. Why do you think no? So remember, Mohammed, here, these are non-refundable tax credits. And we can think of non-refundable tax credits as canceling out the tax on an equivalent amount of income. So for this person, they have taxable income of only $25,000. That's less than their personal non-refundable tax credits here, totaled to line 89. Then above and beyond that, they've got the Canada Employment amount and their CPP and EI contributions. So they will owe zero tax based on that alone. So they will get back any income tax that was withheld by their employer. So they should get an income tax refund. Yes, as we can see, their income is less than 55,867, and so it is only taxed at 15%. So the tax credits will cancel out the tax dollar for dollar. The way I often express this to clients is that you can think of these tax credits, in this case, for example, as canceling out the tax on your first $26,910, which are going to be taxed at 15% anyway. Right? If someone has income higher than 55,867, then that next dollar is going to be taxed at 20.5%. And so that's where deductions such as RSPs become useful. In this case, though, assuming that their employer deducted income tax at source, which legally they should have, then there should be a refund. Now, if this person already owes tax to the government, they might not get the refund, but this directly paid to them. But this year, their tax return results in a refund. Now, I have seen cases where employers, due to negligence, didn't take off the correct amount of income tax. I have seen a case where employers don't take off any income tax at all, particularly if the individual T4 slip is quite small. So you never want to say never 100% of the time, for sure, but almost certainly this person has had some income tax held at source, and thus they will get that income tax refunded to them. As well, they should qualify for the Canada Workers Benefit, assuming they meet all the various other requirements of it. Now, let's keep this in mind. Still on the same situation, let's assume this 20-year-old taxpayer with their taxable income of $25,000 has also made $200 donation to a charitable organization. What additional tax savings would result? So, Grant, you are correct that a charitable donation would result in a tax savings of $30. Karina, I think you're thinking of a political contribution. Political contributions receive a higher percentage, and thus, if this were a political contribution, it would result in $150 of a non-refundable tax credit. And that's because political contributions, you can only contribute a very limited amount compared to charitable donations. So you receive much more upfront and then it rapidly tails off. However, what we need to remember is that this person, their tax has already been reduced to zero by their basic personal credit and their spousal amount. So this person will receive zero additional benefit from claiming a charitable donation. Right, it is non-refundable. He's getting all his tax back already, so the charitable donation will not benefit him this year. It would be more beneficial to retain it and carry forward to any of the next 5 years. Now, technically speaking, this person could transfer the charitable donation to their spouse, but the spouse, as we can see, also does not owe any tax, so will not benefit. So this would be a case where we would keep the charitable donation to one side and possibly claim it in a future year. Now, it's important to remember charitable donations are not tracked by the CRA if they are not claimed. So it is incumbent on the client, the taxpayer, to hang on to their charitable donations and hang on to the receipts and then claim them in a future year, because the CRA has no record of what donations you've made until you claim them. And if you claim them in a year where you get no benefit from them, they still do not record what the donations were. They just record that, oh, your donations were this amount. So for this reason, some people will opt to just claim their charitable donations, even if they're only getting 15% back, rather than waiting to save them up till there's more than $200, just because they don't want to worry about hanging on to receipts. But he does have an additional 5 years to claim those charitable donations. Right, and let's think about this. So this 20-year-old taxpayer with taxable income of $25,000, again, let's see if you remember, will they qualify for the Canada Workers Benefit? Good. Based on what we know, right? Remember, there are some technical qualifications with the Canada Workers Benefit that might come into play, but based on what we know here, probably. So this person meets the age requirements. They are 20 years old. There's a spousal amount indicating they're not single, so we need to know the spouse's income. But even with the spouse's income taken into account, because remember, there is an allowance from the CWB for the spouse to have a little bit of income, this person would probably still qualify to get at least some CWB. If this taxpayer was single and there was no spouse, then the income is definitely okay. Remember, the income needs to be all from employment income, and the income of employment needs to be more than $3,500. And in this case, it's clearly all from employment, so it should be fine. Now, one thing to consider, was this person also in school full-time? That's not obvious from the information we have. If they were in school full-time, then they cannot claim the CWB. If they receive advance payments on the RC-210, then what they get back this year would be reduced, but would not prevent the claim. And also, if the person was in prison for 6 months, they wouldn't be eligible for the CWB. So, again, there are other things we need to check for. There are very few things don't have some exception or not. But in this case, based on what we know, it seems pretty clear. All right, now, going back a second, right underneath the spouse or common law partner amount is a credit called the amount for an eligible dependent, which is also completed on Schedule 5. So, as I alluded to earlier, this is a credit that you can receive if you are, basically think of someone being a single parent is the idea. So If you're a single parent looking after a child, you have the resources of someone who is in couple. So if you are in that situation or something analogous to it, so if you're a single person looking after an adult dependent who's infirm or disabled or something, or that has low income, then you can claim this. So the basic AED amount is, again, the same as the taxpayer's basic personal amount. And again, it's based on the taxpayer's income, and it is increased by 2616 with the Canada Caregiver amount. However, that is only for dependents 18 or over. Children get this money in a different way. So the credit is the same, but it is claimed differently for children under 18. Right. Now, to qualify then, as I say, you can think of this as a single parent credit, or at very least someone who is not part of a couple. So you need to be single or separated or widowed or divorced at some point during the year. And the credit is then reduced by the dependent's net income, if any. It is calculated on Schedule 5 and then claimed on line 30400. Now, you can only claim this once. So even if you are looking after more than one child, for example, or more than one dependent, you can only claim it for one such dependent. And so if you're in a case where one child has an income, maybe they're a teenager working at a hamburger shop, and one child does not have an income, you are not forced to choose the dependent with the income. So you can indeed choose the dependent who has zero income if you have more than one dependent in this situation. All right, it is calculated in this part of Schedule 5, and it's a little more involved, as you can see. So again, we see, notice did the marital status change from single to married or common law in the year? Because that will have an effect going forward. However, again, all that's necessary is for you to be single or equivalent to single at some point during the year. And of course, we need to add information about the dependent. And this is necessary because unlike your spouse or common law partner, where this information is entered on page 1 of the return, for an eligible dependent, that is not the case. So you need to enter this information here so the CRA knows who the dependent is. You indicate if the dependent has an impairment in physical or mental functions. We will talk more about that when we talk about taxpayers and health in a future session. And if that is the case, then we would add the Canada Caregiver amount on line 2 down there. So again, we begin with the basic personal amount. We add in the Canada Caregiver amount, if applicable. And then we subtract the net income, and the net result goes on line 30400 down here. Now, again, as I said, it's a little different if the dependent is infirm or disabled and under 18. If the dependent is your or your spouse's or common law partner's infirm child under 18, you must claim the Canada Caregiver amount instead on line 30500 instead of including it in line 30400. And that is for historical reasons, which, while mildly interesting, are kind of not really relevant to what we're talking about today. If you're really curious, I can just email me and I can let you know what happened there. But we don't need to go into that today. It would be a distraction from what we're talking about. But Grant asks, can you have amounts on line 30300 and 30400 simultaneously? Now, that's a good question. But from a tax point of view, the government, that would be a very large tax credit, so the government does not allow that. You have to choose. It is possible that you could be eligible for both in a given year. For example, consider the situation where someone was single with a child and then gets married during the year. and has the higher income, a higher income than their spouse. You could be eligible for both, but in that case, you need to choose which one would be more beneficial. Right? And we're going to see that as a general pattern when we get talking about more complex situations. In cases where you could choose, you would have two options. You have to choose only one and generally determine which would be more beneficial. But we're going to get into a little bit more detail about this, which I think should clarify this up. So what I would like you to do, and I'm going to show you where this is. I should have pulled this up during the break, but hang on. Let's see, escapee, and then if you go to Inkling, there we go, Inkling, and look at facts and figures. There we go, for 2025. And remember, facts and figures is the document where we put all our various checklists and things like that, and tables and things like that, if you want to look up tax rates and things like that. But in this case, what we want to look is the amount for an eligible dependent. There we go. This is figure 28. So as you can see, this is a checklist. The idea, this is an H&R Block document. You won't find this on the CRA. This is a summarization of all the various CRA rules. So the idea is, in any situation where you need to determine whether someone qualifies for this credit or not, you work through section by section. And if at any point there's a check, if you check a box which is shaded, this means the person does not qualify for this credit. So we're going to go through the various rules on the PowerPoint slides, but if you have this in front of you to refer to as I do that, it'll be helpful as we go. So, and our best practice is to use this checklist every time in order to ensure that the taxpayer is going to qualify for the child and that the dependent is an eligible dependent for AED purposes, and also that the situation qualifies for the claim. If any one of these three can prevent a claim for the credit. And remember, this is a pretty generous credit, so the government, the CRA tends to look closely at these claims if it doesn't seem, if it seems to be a sudden change or it doesn't seem to fit with what is already known about the taxpayer. All right, so we're going to go through each step by step. So first question is about marital status. Right? And again, a check in any shaded box indicates that someone is not eligible for the amount for an eligible dependent. So first question, at any time in the year, notice not for the entire year, not for the end of the year, but at any time in the year, was the taxpayer either unmarried, not living in a common law relationship? If the answer is yes, it's good. Or if they were married or living in a common law relationship, but living separate and apart from his or her spouse or common law partner. So this means temporary separations of less than 90 days, which do not constitute a breakup of the relationship, will still qualify. It is, however, necessary to be able to prove to the CRA that you were living separate and apart from your partner and that they were neither supporting you nor being supported by you. Okay? So that can be tricky for people to do, although of course in some situations it's easier than others, but you might have to provide things like bank statements, proof of separate residence, or something like that. Now, question B, this sometimes leads to confusion, so we want to take our time with this. If someone is living apart, if the two people are living apart, if was the taxpayer either supporting or being supported by the spouse or common law partner? Now, here we are using the basic, common, everyday meaning of support we discussed earlier. Is this person paying for the necessities of life, food, clothing, shelter, and so on? Are they giving this person money and saying, "Here, use this on the rent, use it as you need it"? Are they being nice? Even if they're being nice, again, motive does not matter here. Is support being provided? It's not a moral judgment; it's a financial one. If support is being provided in either direction, then this person will not qualify. Well, Ramin, did you want to make an annotation? Or did you just accidentally hit the button? Yeah, because when you annotate for all of us. I'm going to assume that was misclicked, but just let me know if not. Okay, so now for supporting the other person or being supported by them, there's a very important exception, and that is note 1. Legally required support payments. So these are support payments that are paid pursuant to a written agreement or court order. So think child support payments, spousal support payments as a result of a divorce agreement, or any kind of regular payment like that made on a regular schedule according to a written agreement will not disqualify someone from receiving the AED credit. So that type of support payment is involuntary. It is legally required. It does not constitute support for question 1AB. And this makes sense if you think about it, because people do not always pay their support payments on time, right? So if this rule were not in place, you could have a situation where a taxpayer was looking after a child, but their delinquent former spouse or common law partner was not providing them any actual support, and so this person actually needed financial help. If this rule were not in place, this would prevent the taxpayer in the rough situation, acting as the parent, from receiving the benefits of this tax credit. The government's overriding interest here is in giving the parent better financial tools to assist with providing care for the child. So that's the purpose of that rule there. But the terminology can be a little confusing. You just need to remember that there's a difference between supporting someone in a regular way, which is sort of voluntary, you're paying some of their necessities of life, not because you're legally required to by a court, but because you just want to support them. That is categorically different in nature than legally required payments, which may or may not have been made, which are required by a court order or legal agreement. That's the main thing to keep in mind there. This will come up again. Now, question 2, when we move on. Again, some of this might seem obvious, but the devil is in the details. So, second, was the taxpayer supporting a dependent who is related by blood, marriage, or adoption, right? So it cannot be a friend, for one thing. And the only relatives who qualified for this purpose are a child or parent using the expanded definitions that we saw earlier. Right? Grandchild, grandparent, brother or sister of a taxpayer or the taxpayer's spouse, whether by blood, marriage, or adoption. So again, the extended meaning of child here includes a natural or adopted child of the taxpayer or the taxpayer's spouse or common law partner. And apart from that, a person who is not a natural or adopted child, but is wholly dependent on the taxpayer for support under the taxpayer's custody and control in law or in fact, or who was so immediately before such person reached the age of 19, but not including a foster child for whom the taxpayer receives support payments from an agency responsible for the child's care. Now, looking closely at this definition, we can see that the expanded definition of parent wouldn't really allow for a child in this situation to be the supporting taxpayer for a parent in this situation by nature. So that's why child here is the expanded definition, but parent here is kind of the regular, natural, or adopted definition. Right? Now, more important to note is that other kinds of relatives simply don't qualify for this particular credit. So uncles, aunts, nephews, nieces, more distant relations, they are not specifically listed here among the possible relatives, and thus cannot be claimed for the eligible dependent amount unless they are also a child or under the expanded definition. So, for example, if you have we'll get into some examples later, but if you have a relative who is a minor and you are looking after them, they would qualify as your child via the expanded definition. Now, there are additional requirements. So, except in the case of a child of the taxpayer, the dependent needs to be a resident of Canada. Right? So, for this credit, this is not a requirement for the spousal amount, by the way. It is entirely possible to have a spouse who you are supporting who is not a resident of Canada, and indeed who is not living in Canada. But that's not the case here. So here, the dependent has to be a resident of Canada unless they are a child of the taxpayer. And if they aren't a parent or grandparent, they either need to be less than 18 years old, or infirm or disabled at the time the taxpayer was eligible to make the claim. So if your child is a legal adult and not disabled or infirm, you cannot claim them under this provision. They may qualify for certain other things, but not this provision. In general, if someone is an adult and not disabled or infirm, there are very few things you can claim for them, even if you are supporting them. And we'll note them when we come to them, but certainly not for this one. All right. Anything else you want me to note before I move on? And again, just to reiterate, if you are claiming this amount for a parent or grandparent who you are supporting, it is not required for this credit for the parent or grandparent to be under 18 or infirm. It would be very difficult for a parent to be under 18 and you supporting them. But the disability or infirmity requirement is not there for a parent or grandparents. All right. Now going back, Gwen, you might say, aha, does this mean that because the child does not have to be a resident of Canada, that the child could be in another country? Unfortunately, no, because that's a resident for tax purposes. It's possible for the child to live in Canada but not be a resident for tax purposes. It is, however, a requirement that the taxpayer resides in and maintains, either alone or with others, the dwelling in which the dependent resided. So the taxpayer needs to be a resident of Canada, living in Canada, and therefore the dependent must as well. This leads to an interesting second rule where only one claim for this amount can be made per residential dwelling. So if any other taxpayer is claiming an amount for an eligible dependent in respect of the same dwelling, then it can only be claimed once. So if that has already been claimed, then no additional claims can be made. Now, so you can see the implications for this in, say, a situation where a couple is split up, but one of them is living in the upstairs of a house, one is living in the basement suite downstairs, and they are sharing custody of the child. This can happen, and I have seen it happen. In a situation like that, only one person could claim the amount for eligible dependent. But it also is the case where if you had two unrelated people who, each with their own children, but it was more of a roommate or house sharing situation. So, for example, if one person is upstairs with their child and another person is downstairs with their child, and they're not related, they each have their own child, but they are in the same residential dwelling, only one of them can claim the credit. It's a bit of an odd rule, but it's intended to prevent abuse, but it does have some odd side effects as a result. All right. And Valerie is asking, is this the only time a sister or brother is in the definitions for tax credits? Remember that someone may qualify for some credits and not others. So there will be other situations where brothers and sisters may come in. Generally, it's going to always be in the context of a dependent. Are you supporting them in some way and therefore able to claim an amount for them? So we are, off the top of my head, we will see this again when we get to medical expenses, for example, and certain other credits. But bear in mind, for any given credit, the list of qualifying relatives conceivably could be slightly different. And of course, if your brother or sister is under 18 and you are an adult looking after them as the only adult, then weirdly, it's like, let's say the parents are dead and you are looking after your surviving younger sibling and you're an adult and they're a minor, then legally speaking, for tax purposes, you legally speaking are the parent of the child, even though you are siblings. So it can have some odd effects, which is why I'm always saying for tax purposes only. All right, and yeah, okay, 27. Okay, good. Now there are some other restrictions. So first, you can only claim the amount for eligible dependent for one person. So if you're claiming it for any other person, you cannot claim it a second time. Also, if any other taxpayer is claiming any personal amount for the dependent person, you cannot claim the amount for eligible dependent. So if they're not eligible to claim that, then neither can you if they are claiming other things. The only exception is the spouse in the year of marriage or separation, but we will talk more about that in an upcoming chapter. We also have to say, is the taxpayer claiming a spouse or common law partner amount for anyone? So again, you cannot claim spouse or common law partner amount and the amount for eligible dependent. Even in the year of a marital status change, you need to choose which would be more beneficial. And lastly, is the taxpayer required by a written agreement to make child support payments on behalf of the dependent other than the year of separation or reconciliation? So, for example, in a year where the child, a shared custody arrangement, and the child passes from the custody of one parent to the other, and support payments are involved, say, so you're making support payments, child support payments for the dependent, but part of the year the child is living with you, you would be unable to claim the amount for eligible dependent, with the important exception. If it's a shared custody arrangement or a half-year split or something like that, if this rule, and only this rule, would mean that no one can claim the amount for eligible dependent for the child, then the rule doesn't apply. And instead, the parties need to agree who is going to claim the amount for eligible dependent for a child. And again, this means that if there's more than one child, then each of them could claim the amount for an eligible dependent for one of the children. Right. So there are some interesting effects of all these various rules when we work through them. All right, we're going to talk more about that in chapter 12 when we talk about more complex family situations. At this point, we're mainly focusing on situations with a single taxpayer. All right. Okay. There we go. Now we already took our breaks, so we won't take. We have the option of doing 2 short breaks, but I think that on Sunday I found that it was just easy to take one long one. So we've already had our 15 there. Right, but we will have one more poll question. Where did that go? There it is. And let's get up here. All right, so Cameron is a single parent of 16-year-old Joshua, and Cameron's net income is $71,000. Joshua had a part-time job where he earns $2,000. Joshua is not infirm. So, with all that in mind, what is the amount for an eligible dependent that Cameron can claim with respect to Joshua on his return? Is it $0, $2,000, $13,705, or $15,705? I think that's pretty straightforward if you've been following along. But let's see what you think. Let's see here. Oh, there we go. All right. Looks like there's a clear favorite answer. All right, and most of you got this correct. So the answer here is C, 13,705. So, first of all, Cameron is eligible to claim the amount for eligible dependent, assuming that all the other conditions are met. So, the amount that is claimed is going to be his basic personal amount, and because his income is not in the 4th or 5th tax bracket, he will begin with the full amount of $15,705, but we will deduct Joshua's income. So 15,705 minus 2,000 gives 13,705. Okay, and Mohammed, you're asking, can a tenant get any benefit? Can you clarify a little bit? I think you might be referring to a previous slide, but I'm not clear which slide it is. Oh, no worries, man. No worries. Tenants, the main benefit for tenants is really just the BC Renters Tax Credit. if you are a tenant, you can claim that. It's not going to have much effect on other things. And I'll let you know if so. Okay. All right. Let's try to solidify what we've been talking about. And let's have a look at some various examples to see how clear they all are. So, Albert and Betty have been common law partners for many years, and they have 2 children. So, if anyone, can claim the amount for eligible dependent? Albert or Betty or neither or both? And again, if you want, you can refer to the checklist for the amount for eligible dependent if this will help you with any of these. All right, so the answer here is neither, right? Remember, you can only claim the amount for eligible dependent if you are single or separated or widowed or divorced, and there's no indication that that's the case here, right? That's the fundamental thing. And again, this doesn't matter whether you're talking about children or adult dependents such as a parent or grandparent. You have to be single, separated, divorced, or widowed, not married or common law. Yeah. As I say, if you think of it as the single parent credit, then it really tends to make it just a lot easier to stick in your head. All right, Cam and Dawn have been common law partners for many years. They have 2 children. But in April 2024, Cam moved out and the kids now live with Dawn. But Cam, not being a jerk like some of those earlier examples, continues to pay all the bills, rent, utilities, etc. So who, if anyone, can claim the amount for eligible dependent? Cam or Dawn, neither or both? Okay, so it can be helpful in situations like this to have the checklist in front of you and work through it. So if we had the checklist and we looked at the first question, 1A, we would say, yes, they are living separate and apart, so far so good. But then when we got to 1B, we would say that him, yes, sorry, maybe that language is unclear. We need to nudge that. They broke up. Yes, in this case, moved out, and it's the end, right? It's now, they're doing the tax, right? So it's after December. So Cam moved out and stayed out. But I can definitely make that language a little less ambiguous next year. Yes, no, Cam has moved out and stayed out, and the kids now live with Dawn. So now here, the answer is neither, but for different reasons. So Cam, remember, is supporting Dawn. He's continuing to pay all the bills. So even though they are living separate and apart, financially, they are not. So here we would have a check mark in a shaded box. So Dawn cannot claim the amount for eligible dependent because she is being supported by Cam. And it's not because of a legally mandated court order or written agreement. There's no There's no coercion involved, anything like that. She's just being supported in the regular way. So financially, it's as if she wasn't single. So Don cannot claim it. And Cam also cannot claim it because he is making the support payments, and also the kids are not living with him. Now, if there were no support involved, or Cam was paying only support payments, then Don could claim it. But in this case, neither. Okay, so sorry, we're working our way through the alphabet. Evan and Fran separated in 2024, and their children live with Evan. When Fran moved out, they both signed a written agreement stating that Fran would continue to pay the heating bill and half of the mortgage until such time that they were able to sell the house, which has not happened yet. So, who, if anyone, can claim the AED? Evan or Fran, or neither, or both? Good. So, again, working through the checklist, they are living separate and apart, and no support is taking place except support according to a written agreement. So, in this case, Evan would be the one who can claim the amount for eligible dependent, again, assuming that all the other qualifications, all the other conditions on the checklist are met. So far, based on what we know, Evan can. Okay, so Harpreet, our old friend, is single, and after a year of going through the adoption process, adopted her son Krishna in the summer of 2024. Yes, the checklist in facts and figures, that's right. Right, so in this case, can Harpreet claim the AED? Good. This is completely unambiguous, right? Harpreet is single, full stop, and her son Krishna, adopted, qualifies. Although I should add Krishna's age to this one, in case any student forgets the age. In borderline cases, all that matters is that the dependent was under 18 at some point during the year. And again, providing all the other requirements are met. Providing all the other requirements are met. Okay, now, so guys, how are you feeling? Everybody feeling reasonably comfortable with this? Okay, good. So you are going to have some time to work on the chapter review problems before our next session. So we will have some time next session to look at that as well. We got about 15 minutes left, so I think what I will do is I will show you the provincial amounts, and then we can have a brief look at 8-2. So for the provincial personal amounts, these are going to vary by province. And in all provincial cases, there may be small differences from the federal amounts. So you want to pay attention to that. But for British Columbia, they're relatively similar. So don't worry, Karina, this is only going to take a couple minutes because British Columbia, relatively straightforward. And I believe I got it right here. So good job, me, from yesterday. So for British Columbia, then, Included with this is the age amount, just because it's on the slide. You haven't really talked about it yet, but it's pretty straightforward. It's if you're senior, and so the calculation for this is on the BC worksheet. For BC, notice that the basic personal amount is $12,580, but the spousal common law partner amount and the amount for eligible dependent are less than that. So this is different from the federal amount. And the form, it can be a little misleading because the maximum you can claim for either of these is $10,772, but that is not the first number you see on the form. Because what happens in British Columbia, and it's a little weird they've set it up this way. I understand the intention, but it looks strange, and I think it could lead to confusion. You are allowed to have your spouse or your eligible dependent can have income of $1,078 before it starts to reduce this amount. So in order to reflect that, they begin with a base amount of $11,850, and then we deduct any income, and the maximum is $10,772. Okay. Apart from that, otherwise the same rules apply provincially as federally. If someone qualifies as an eligible dependent federally, they will provincially, and vice versa. Similarly, spouse or common law partner, there's no variation there. In some provinces, conceivably there might be, but more likely you would see some variation in the amounts. Okay, so that's fairly straightforward. We just like to touch on it in passing, just to remind students that the provincial amounts are going to be a little different. All right, let's jump over to, if it's negative, you just enter 0. That's right. So in other words, if their income is so high, you're not really supporting them because they have their own income, so you will not claim a credit for that. Sorry, Karina, what do you mean? Oh, for the basic personal amount for British Columbia, it is $12,580, which is both different from the federal amount and different from the amounts for spouse, common law partner, and eligible dependent. Yeah, again, it's odd. I'm not familiar with, and I don't understand the policy reasons why British Columbia has made this choice. And unfortunately, I never seem to get the time and energy to do a survey of all the various provinces to see what if there's any really big variations across the country. So off the top of my head, I'm not sure how unusual British Columbia is in this regard, but I have a feeling it's something of an outlier. In general, the trend with British Columbia credits, though, is that they will follow the federal pattern, but the amounts will be lower because British Columbia tax, at least in the lower brackets, tends to be lower. But, with other provinces, I don't have as good a sense of the pattern. All right, we will talk more about British Columbia credits as we go through the course, and we'll have some time in chapter 14 for a wrap up on it. So not to worry if we come across other things. In particular, when we talk about health and medical expenses, British Columbia has some interesting things which are unique to the province. All right, but for now, let's have a look at CRP 8-2. Okay, which is, of course, in fundamentals, income tax. There we go. All right, I'm going to read through the problem and then just show you guys the solution. And if you have, and if that leads to questions, great. And we are just continuing with chapter 9 next time. So next time in our next class, we're going to work on the chapter review problems in that session. So don't worry. We will have some time if any more questions come up. But for now, let's look at 8-2. So this is the problem for Darren Leduc, who is divorced and lives on Bank Street in York City. So he's employed as a machine operator by Molnar Manufacturing, and for several months during the year, he has collected WC benefits. In December, he won the lottery, but it wasn't like crazy life-changing money that would really lead to complicated tax situations. No, he just won $10,000. So he spent the money on more lottery tickets and a weekend trip to Las Vegas, but did contribute $5,500 to his RRSP. And he's got an official receipt from TD Bank dated December 20th. His RRSP deduction limit for the year is $1,500. He lives outside CMA and is a Canadian citizen. Doesn't want to provide information to Elections Canada, and the only foreign property that he owns is a property in Connecticut. He inherited the property in 2020, and we have its fair market value then and what it is worth now, and he plans to sell the property next year. You see his T4 slip here with income of $27,500, and the income is down there, and then we have his T5007 there. So we are going to answer some questions and then complete his Schedule 7 and then complete his T1135 if applicable. Now, I should have just so hang on one second while I pull up the slides that are relevant for 8-. Okay. 8-2, which are in the presentation from last time. There we go. Don't worry. Okay, here we are. Right, there we are, and there we go, and chat window here. All right, so for 8-2, okay, so for each of the following income amounts, we need to think about what is the amount that Darren needs to report and the line number on which you should report it. All right, now I do have those answers. I will pull those out. But if you've got yours handy, please feel free to put them in the chat. So first of all, employment income, I think that's straightforward. He's going to need to report something. And I'm missing a page. All right, so there we go. Stuck with it. So for line 10100, yes, it's straightforward. It's 27,500. And for the WCB benefits, these are going to go on line 14400, and we just report the full amount from the P5007. So that's going to be 18,980. And lottery winnings, what needs to go on the return? 0. That's right. They're non-taxable. There's no such thing as professional lottery player, right? And gambling winnings that are not from professionals are not considered to be income. All right. Now, when we look at his return then, what amounts could be deducted from the total income? And what are the line numbers for that? So there's 3 deductions here. So the RRSP deduction is a big one. How much can be deducted there? the RSP. I'm not seeing it here. 1,500, right? The deduction limit is 1,500. It's only 1,500. For the enhanced contributions for line 22215, that should be 240. Excellent. Again, 1% of the pensionable income over and above the basic exemption of 3,500. Good. The union dues on line 21200, $343. For personal amounts, obviously he's divorced, no spouse, so he will only be claiming the basic personal amount. Salary, yes, 18,980 for the WCB. Other payment of 25,000. Not sure what you're referring to. Oh, line, yes. Yeah, we'll get there. That is ambiguous. Actually, I need to tap my coworker on the head about that. So when we say deductions from total income, I understand the intent of the question. What we mean is what deductions are made in the net income step. So what deductions are made in step 3 of the tax return from total income. Deductions in step 4 of the return are deductions from net income. So the WCB of 18,890, yes, we can explain that, Mohammed. That is, so the 18,980 is right here on the T5007, workers' compensation benefits in box 10. So those are reported on line 14400. All right, going back to the questions. No, other presentation. WebEx's menu is getting in the way of my tabs. It's very annoying. Oh, there we are. Okay. So now here's a question for you. What can be done with the excess RRSP contributions that Darren has? Right? Good. Under certain conditions, if he withdraws them right away, you can use one of those forms to remove the problem. However, if that hasn't been done by this point, then he is going to have to pay a penalty tax. Okay? Now, we're not going to get into calculating that in this course, but we need to be able to recognize the situation where this happens. So, think about it like this. So what would happen is that he makes this contribution in December, right? So he overshoots his limit. So his limit is only 1,500, and he put in 5,500, I think, and so he's over the limit by $4,000. He has a cushion of $2,000, and that means that in December, and only December, he's over the limit and over the cushion by $2,000. So he would pay a 1% tax on that per month. So for December, he would pay a $20 penalty tax. Then on January 1st, new contribution room opens up. And the $2,000 cushion comes back in effect. So then the calculations would all reset. So assuming new contribution room opens up in January, then that would probably be enough to absorb the problem. Okay? But in cases where it's not going to be so neat and tidy, so if he doesn't want to pay the penalty tax and let this carry forward, then he can do one of the forms. Right. All right. And again, in this course, at this level, we're not going to ask you to fill out those forms because they're a bit involved. All right. So last thing, I'm going to show you Schedule 7 from the tax return. Okay. So that should be down here. And Mr. Leduc, you are right around here. Right around here. There we are. So it just, the rest of the return is fairly straightforward, but if you have any questions, just let me know. Let's look at his Schedule 7. This is what we asked you to do. So in Part A, we would see the contributions. So the contributions, $5,500. In Part B would be repayments under the HPP and LLP. There aren't any of those in this case. And I'm just going to. So Part C is the RSP deduction, and the deduction limit is only $5,500. So the amount which can be deducted is $1,500. Very straightforward in this case. So then the unused contributions available to carry forward here are $4,000, and they will show up on the show up in the notice of assessment for 2024. And that's it. That's all that shows up in Schedule 7. So notice the overpayment, penalty tax, all that stuff. None of that is on the Schedule 7. This all has to be prepared and submitted on a completely separate form, which is very onerous to fill out. We will get into that in a higher level course. We do not want you to worry about that. Just be able to recognize what's going on. Okay, and for Darren, well, our last question, as always, would be, does this tax return make sense? So if we look here, Darren is getting a refund of $2,153.55. And this makes sense because he had a lot of income tax taken off, presumably because he was injured partially through the year, so the income tax taken off was at a much higher rate than his actual income wound up being. So his actual total payable for the year was only $1,562.58 because his tax credits were relatively high compared to his income. But yeah, his deductions are pretty basic, just the basic personal amount, CPP, EI, Canada Employment amount. He didn't go nuts and make a bunch of crazy deductions or anything like that. However, he does deduct the RRSP. Now, piece of tax advice we could potentially give him to say, hey, Darren, you're only getting 15% back on this RRSP. It might be more beneficial to claim it in a future year. But again, he's in a situation where he's already over his contribution limit as it is. So it's probably for the best to claim the maximum amount. All right, and Karina is asking, is everybody eligible for the Canada Workers Benefit? Oh, that's a question to ask at 9:04. If you review that chapter, I don't have time to get into it right now, although if you hang around for a few minutes, I can talk about it. Go back and look at the chapter, because you can see that there are a series of qualifications for the Canada Workers Benefit. So, for example, you have to be a certain age. You have to have employment income over a certain amount, but also under a certain amount. You can't be in prison. You can't be a full-time student. You can't be a part-year resident. So there are things like that. But in general, providing you are working and have employment income, then or business income or similar income, which is similar to working income, then you can be eligible for the Canada Workers Benefit. Yes, absolutely. All right, on that note, so chapter review problem 9-1 we are going to look at next time because we have time next time. So for next time, so have done 9-1, 9-2. We have some time set aside at the beginning of next class to do it, to work through it. So by all means, and just start reading chapter 10. We are only going partway through chapter 10, up through exercise 10-7. So don't worry about the chapter 10 chapter review problems, unless of course you're extremely keen and just want to do it. All right. On that note, I think we can wrap up the recorded portion anyway. So thanks all of you who were downloading this online. Again, if you have questions, I don't mind answering those if you email them my way. Or of course, just have a look at the textbook. There's more details in the textbook than we can get into in a 3-hour session. And of course, your own instructor should be able to help you as well. All right, thanks and good night, all of you out there in internet land. And for all of you in the class here, thanks for hanging in there. Excellent work as always. I will keep the room open